Hello, and welcome everyone to the weekly Delphian meeting. Thank you for tuning in. So today's agenda, we'll do a market update, review the earnings trades out there, and then do some analysis. We'll go through that. So let's get started. Okay, overall market, you can see SPX, NDX, Russell, all, Dow, all still in one. Russell barely hanging on. Um, same with like the ETFs. We only got 1 in 8. That's XLE. Big picture pie. We've had a nice little drop, from 77 down to 68. And the state ones are still holding up pretty good, only down to 49. So that's still overbought condition right now. But we'll go through the analysis here. So, we peaked right around 51, 52 kind of, so we're barely lower on that. Obviously, you can see the eights have picked up quite a bit. Those sevens are basically transitioning, not to five, which is, like in a like longer term bullish. Those fives and sevens are dropping back into eights, so that's where those are going. And we're also getting nice little pickup in the twos. So, if this is going to be a bullish market, we'll see a lot of this, going back 1, 2, 1, 2. So we'll just have to wait and see, as the stronger names start pulling back into twos, like I think Russell will probably, that one looks like it's going to be a 2 any day now. So we'll see. New highs, lows, so nothing significant, a little bit there, but nothing really going on here. The lows are still kind of flatlined. Those lows don't really pick up until we get bigger numbers in 8. That's where new lows are made. So the numbers are climbing in state 8. So if we get downward moves, we can get little spikes, but nothing like that. At least not, it takes a while to build up to get these kind of levels. Obviously, you could see, things start building up here. But, I think, the key thing to watch is going to be these levels that we talked about last week. Just bullish, bearish, pull that up real quick. Now we changed the navigation a little. We put market pulse here front and center instead of buried in the sector analysis. So this little change. So we got up 84. So we're down 68. I mean, most of the time, not all the time, because you see here 70 goes, only went down to upper 50s, but a lot of the time when things turnover like they have, they normally cross, but not all the time. So just you can see here, it's like peak 80, drop way down. So a lot of the times it will, once you turn over, here, obviously this one didn't, but so the odds are, that it'll kind of continue. But no guarantee, obviously. So we'll just have to keep our eyes peeled on that. But that's just the momentum, so it seems like it turned over pretty hard. The market had dropped a ton. We'll go to SPX first. Like you can see last week we were right here, basically on that target 3 level. We popped up a little bit and, basically, another attempt to run away from that. And it's just, basically sucked back right to that target 3 level, 47.35. So we're below it right now. So that's not a good sign, obviously. If this is, let me get the tool out. If this is acting like strong resistance, which it normally does, bullish wise, we want this to, come up here and hold, and this act like support, but it's obviously acting like really strong resistance. You got here, you got a breakout attempt failed, breakout attempt basically failed at this point. So obviously it's not a good bullish indication. Obviously if we turn around, if we can get back above there, that's bullish overall. But pretty much average. We're right there. At the time, we've made a little bit better than average move, obviously, but times pretty much right there. So, obviously this level's the key to the watch. And then, we got some support last time. It dipped down here, so that's something to look at. But, even more importantly, right below that is 4,600. That's the bottom of our current range. So those are kind of the, there's your resistance, support, and support. Obviously, way down below, it's kind of off the radar right now, the entry point. But, that's the kind of three levels I'd be looking at for SPX. Let's pull up the chart here. So it's made runs for, that, what was that all-time high? Try to make runs at it. I think it's 48.18, 48.18. So made two kind of little attempts here to try and run up towards it. But, this last one, 48.02, kind of the high. So, tried, but looks like it failed again. So we'll keep that's obviously the top end of that, like a resistance level. So we got that, we got T3, and then the other two I laid out on there, on the other chart, but that's our current range. So, the big things, obviously 46, if we do push lower, holding that would be very good. Even if we go into two, we gotta, hold that. That's our good bullish case. Yeah, we hold that. So that's it for SPX. Let's go to Russell last week. We're right on that level. So same thing, like SPX, but on the bottom here, it's providing good support, but also, it's kind of like resistance. It's trying, um, and obviously it's trying to hold up, but failed here, and even today, we're down lower, pretty much right on our critical level, 1900. So if we don't hold that, I would expect state two. I would expect state two any day now. Obviously, we're below the, we broke this. We're down here somewhere, so I would expect this to be two any day now. So obviously not, a stellar state one for Russell. I think the big thing driving Russell, we need to look at the 10-year, and how that has behaved. Let's pull up the chart here. So that's when rates peaked, the recent peak. So that was like right at 5%. So, dropped all the way 378 or something. So, you look at the dates here. When did the Russell really take off is right in here, right? 28th, something like that. Just ran straight up. And then end of December. Sorry, wrong one. End of December. There it is. It's the bottom of the rates. So this is just, not so much with, the SPX, but I mean, that's the peak of that run up, right? And that's, I mean, look at that. It's like right on, right? It's the the bottom of the rates, you know. So this is becoming, you know, Russell's pretty much acting like a interest rate play right now. And you look at those moves, you know, that was like 27. So that's when things start coming down from 5%, ran all the way up. You know, that's pretty crazy. So I would, big thing with this is watch the rates. You know, obviously had that huge move down. Um, and, I think people are kind of hedging back their expectations on cuts and stuff like that, or at least like when they're going to occur. So we'll talk about that in a minute. But uh, so on here, obviously we got, our stop loss level, which, is going to be resistance where we're at. And then, the key is 1900. So let's pull up the big one. I'll pull it out just so we can get the weekly reminder of the now four peaks. Yeah. All right. So 17, 19. Obviously that tops at 21. So it's pretty much repeating, which what we're kind of afraid of. Obviously, this one's been the most steep. The first one was pretty steep. This one, the second was even pretty steep. This one was more gradual, the third one. And then, this was this crazy, bottom of the top. And this was all rate driven, in my opinion. So rates have, started coming back higher. So now we're back at the 19 level. Yeah, they all did that, retested the 19 and failed. So this is the key thing to watch, I think, overall market wise, is just, 1900, get above that and stay. You can see back here, first one, went back, tried, failed. Here, second one had a lot more, back and forth right on that 19. The third one, went through it, came back, false breakout, all of them went back down to 17. So, hopefully it's not repeat, but this is the level, keep like a broken record here, for July, almost, coming up year and a half more or more. So, okay, so let's Russell. Rates. So January, nothing cooking. So March, kind of a coin toss right now. So, last week we're at 65. So that's they're, tempered their expectations. I'm not sure about March right now. I would be leaning towards not, but we'll see. So the first kind of market wise cut expectation would be May right now as a firm, first cut. So, and then nothing like long term has really changed, pretty much flat, you know, as far as expectations, nothing really month over month or week over, nothing really changed longer term. And that's for like the December, but things have moved a little bit, front end. So, but like I said, 10 years popped up a little bit, from that 378. So the higher we go, the worse it is for the market. If we get back up, last time we hit that, the market was looking real ugly and things just turned around. So, a balance sheet, nothing, no runoff. So, I hear a lot about like, um, what's it called? Like the overnight lending and stuff like that. I just kind of hear things in about that, but there is another facility that they built for lending that's going to expire, I think, in March. And that was from the, a side effect of that small bank failures like Silicon Valley and stuff like that. So I don't think that one's going to get re-up. So March is a lot of things there. We talk about, hitting that kind of magical percentage. That'll probably be March. That's 7.5 trillion. This emergency facility is going to, basically vanish in March. I don't think they'll re-up it. So, and then, possible first cut. So March is going to be, very interesting. So I think that was it. This is just like the M2 kind of chart. I saw this one last week. Obviously, red is M2, and CPI basically following M2. So that's where we're at currently. And, if this holds, then obviously we'll see a big drop in, inflation, stuff like that. And then, we would expect cuts. So, if this holds, so no guarantees, obviously it's done a really good job of, mirroring. So, like a little uptick like this, I don't think there's anything to worry about. Obviously if it starts, trending higher, kind of from this level, then that would be a problem. But we can get some shuffle and it's not exact. But if this holds up, then I could see excuse me, a definite need for cuts, but that's no guarantee that the 10-year is gonna follow what the, if the Fed cuts rates, that doesn't mean the 10-year necessarily is gonna go lower. That's a supply demand type thing. With the Fed tightening, you know, that that could also pose a problem. We talked about that. So that was it. I'll open up to questions, comments on the market overall.
Agree with you. I think it's rolling over.
Yeah. Yeah, we'll see the 19. Yeah, that's gonna see where if we break through there. Looks like we will. All right. Thanks, Sadir. Anything else? Anyone else before we
Josh, Robert here.
yeah, hey.
Yeah, I like the CME watch tool. Have you seen the OPEC watch tool the CME has?
The what?
The OPEC
No,
watch tool. Yeah, I just discovered that this morning.
really? Oh, where is that? You have the
It's
link?
on same site.
Crude?
That's the overview. We might find it there.
Yeah. Counter margins, but
Let's see. It's called the OPEC watch tool. Let me see if I have it over here.
there you go. CME.
OPEC watch tool. That's it.
Yeah,
And
cool.
I believe we have a meeting coming up.
Yeah, I don't. February 1st. Yeah.
Yep.
Huh. That's pretty cool. I didn't gonna bookmark it.
So what is it predicting?
Whether they're cutting or easing
Oil
like
prices?
production.
Production.
Yeah.
That's interesting.
Yeah, it is interesting. Wow. Can really dive into this, huh? That's cool. Yeah, thanks. So many good tools out there, you know, geez. Holy cow. Wow, this is really cool. All right. Thanks, Robert. Added to my toolbox. Thank you. All right. Anyone else? Questions, comments?
This is Dave. I think you're right on the current sentiment about the rate cuts. I think that's what you feel the rate cut, coming out of the major indices here, or the lack of rate cutting expectations are being a little more reasonable now. So,
Right, right.
and we had a run up right at the end of the year, so that was probably a little bit exaggerated too. So it's not surprising. We'll see what the tech earnings are in about 2 weeks. I think they're mostly right at the end of the last week of the month,
Yeah.
first
Yeah, I
week of
think,
February.
yeah, we've had some bank earnings. I think most of them were pretty good, you know, from what me and Joe were discussing. So I'm not sure. I know yeah, Joe has some earnings stuff. Um, I'm sure we can talk to that stuff. Like the expectations obviously dropped quite a bit. And,
Yeah.
Yeah, those earnings that came out last Friday, Josh, with the exception of Wells Fargo, everybody beat handily.
mhm. Yeah. Um, what's the big elephant? It's this guy. It's in here, right? So, okay. Thanks, Dave. Thanks, everyone else. All right. We added a new little feature. We haven't tweaked it yet, but we'll put in like watch lists here. So now, because before it used to just be you had like the watch list and you could only use it there, but now you can use your stock list. So any stock list you build and want to use throughout the system in any other place, you know, you can pull up the watch list here. You know, we're going to tweak the screen some, but you know, you can add and delete things here. So this makes it a lot easier and a lot more usable, the stock list. So it's pretty cool. So, all right, virtual portfolio. So we had, we'll start with the bad news. Delta. Yeah, this one got crushed. Um, so this Iron Butterfly put on the 11th for their earnings. I don't think it was that bad, but obviously it's moved well against it. So, you know, your price here is 37, the low end here um, is 40. So you're below the, you know, the bottom and it's looking max loss right now. You got till 19, so you got, you know, till Friday for this thing to come back. It's not looking good though. So that was bad. You know, the other one obviously closed out a winner, but we usually have one loser with those, but it's not a good one there. Like the whole Boeing thing didn't really help either, I think. Losing airplane doors. So yeah, bullish pre-runner. So you know, that's 6 active, nothing's closed out yet. You know, the financials, most of these are financials. Um, you know, obviously, you know, down a bit. Still got some time, you know, 22nd can be earnings for these. So, but you know, down a little bit, you know, the market's down, so that's where we're at. And yeah, that's it. Any questions on that?
I was traveling and I missed the Delta trade. I'm glad. No,
Yeah, good.
I, I was out of the country.
Yeah, right. Someone's looking out for you.
Yeah.
Yeah, I mean, those, you get those, you have a ton of time, you get a few maxes, a year, but generally they pay off, so, yeah. Okay. Anyone else for, Jim takes over? All right, I'll hand over to you, Joe.
All right, Josh, thank you. Everybody. Let's see. Few charts. Yeah, not that much, has really changed on the home page, as Josh has pointed out. We still got state ones across the major averages. Robert mentioned, that new tool. So I will pull up the XLE because it's the only one of the 11, sectors that's in a bearish state. But let me start with Russell, and just to the point that you've all made already. Actually, let me. There's Russell. Just there seems to be an adjustment in the market, with regards to future rate cuts, and certainly the price action. If we take the three indexes, SPX, Nasdaq, and Russell, we talked about this last week. After those monster runs, time for a pullback. Let's talk retracements. Last week, I think we're at 1941 in the Russell. As Josh pointed out, we traded down to 1900 this morning. 1900 is the 3/8 retracement, of the run from October. So it'll be interesting to see if, let me see that gap, which we, had filled quite a while ago. Just be interesting to see whether, the 1900 level holds. If we're going to continue to roll over, the other retracements on the downside for Russell are essentially, we're talking 1900, 1850, and 1800. So I would think, as we've all kind of suggested, the interest rate market's going to have to move back up quite a bit to get down, to those levels. But we're clearly seeing an adjustment in the 2000 versus, the S&P and the Nasdaq. I mean, it's barely been a blip of a correction, with the SPX. We need another 200 points down from today's level. Basically, you're talking 45.40 would be a 3/8 retracement, in the SPX. So, long ways down, to get anything there. And SPX, or excuse me, NDX is about 800 points. So still really lots of strength in the market. In terms of, we're on in terms of the average number of days, obviously with these monster run-ups, we've exceeded the average move as well. But, that's why we've added, the maximum percentage move and the maximum number of days into our snapshot, on the state modeling page, just to offer perspective, in terms of history. So, as Josh has been talking for a couple of weeks, we'll see if this 1900 level holds, in the Russell. XLK, basically just, a pillar of strength. So, do we back and fill a little bit? Dave, I think you also hit the nail on the head. Those tech earnings that come out, in a couple of weeks, going to be really, so important, for the future direction of the market. And, my guess is they're going to be good, and the market's heading north. TLT, just we are still in state 5, and beyond the average number of days. So it'll be interesting to see whether TLT can roll into state 3, coming out of 5 here, or whether we go, into an intermediate bearish, phase. But something to keep an eye on there. And then was reading, I saw a headline the other day coming out of the Chicago Board Options Exchange. They were talking about unusual option volume in FXI. Honestly wasn't even familiar with what the heck FXI was, but it is a Chinese big cap, large cap ETF. So I figured, yeah, let me go back and take a look at that. And one of Josh's favorite terms is the death march. I mean, FXI. I think if you look at this thing, it has certainly been down and dirty for a long, long time. Here's the long-term chart going back to 2008, just to give you a perspective. I also, went in to do a little bit of homework on this, and getting Chinese numbers is always challenging. I guess Google Finance was showing this particular ETF is supposed to mirror an index on the London Exchange, the FTSE China 50. I go in and try to find a chart for that, and no chart available. So anyway, I just, China being as important as it is, this may be a symbol just to keep an eye on, in the back of your mind, just to see if, we're to ever come out of this death march to the downside. The 878787 we're testing, significant previous lows. So just something, as I said, to possibly keep an eye on. FXI, large cap China stocks. And then just the other thing I want to do is just remind you, and I think you probably all know this, but we send out the weekly upcoming earnings email Sunday at noon. We try to offer different information on there in terms of, and from time to time, we will change the columns. We go in and try to make sure that our data is accurate, of course. But so there were 3 for the upcoming week. 2 were confirmed, 1 was estimated. Different stats like how the stocks performed, on the previous trade 20 days prior. We do that with the bullish pre-runners. With the bullish runners, we talk about, the action of both the individual issue and, one of the big indexes 20 days post. So just a reminder, I don't know how often, you open those emails, but that comes out Sundays, 12 noon generally, the upcoming weekly earnings. And then, we follow like this morning. We got the morning trade alerts and, what the weekly doesn't do, obviously, and can't do is offer strike prices because, the trade's in the future. What the daily alerts, of course, do is get more granular and, tell us what strikes, trade type, and away we go. So I just, I took a look at Goldman's chart, which honestly I haven't looked at in ages. And so, today's suggested trade is, the bull put spread. It's a, 35-point put spread, taking in, about $10, just rounding off here. But, most important, from my perspective, with any trade is what are the strikes? So we're suggesting, just that out of the money put at the 375 level, shorting that and buying the 340, and just there's, the recent chart, in Goldman. So, we're talking about essentially, getting long around 375 with protection down around 340. So, for me personally, I would, and I know Sadir's talked about this before, picking different strikes. I am optimistic on the market. I think that will be important, for, a stock like Goldman, going back to the weekly, information, last time around, Goldman ran almost 10% when the market ran 3%, 20 days, after earnings. Just always evaluating that strike. I'd have a hard time shorting the 375 strike here. I would take, Sadir's style and pick something lower in terms of my strike. So basically left less delta. And that really is just because we had such a run, you know, basically from 350 to 385 or wherever it was in the last month or so. So I would be cautious personally about selling that 375 strike, but not unwilling to put on the trade. It would just be a lower strike. One other thing I wanted to
take a lower strike today. I entered the trade.
Okay, good. I said it.
Not at 370.
Go ahead.
I think I was at 350 or 355.
Okay, and you know you got a gap here at you know, basically 360 and change. But I'll tell you, and I think, you know, I'm not sure how much time everybody has to do their analysis, but I went back and looked at a longer term chart in Goldman. And, you know, Josh pointed out we added, you know, the watch list feature, and, you know, find the long-term trend lines and, you know, trading breakouts out of the trend lines, you know, can really be beneficial. You know, I thought there was a heck of a trend line here in Goldman, and lo and behold, you know, stock took off, and, you know, they're all kinds. We're pretty much just in the camp at this point of doing bull put spreads. That'll change, you know, once we get everything on the back end straightened out. But, you know, being able to add different stocks with major trend lines to your watch list. So I would just encourage you to do it if you have the time. Keep that perspective of longer term charts, which I'm sure, you know, all of you do. And, you know, just, yeah, just, you know, something, just a reminder to keep in mind if you're not already. So that's, there are just a couple of things I wanted to point out. Happy to talk about anything or pass it back to you, Josh.
Okay, thanks, Joe. All right, anyone else? Questions, comments, anything?
Yeah, Josh, Robert again.
Yeah, here we go.
Yeah, just a comment on that OPEC watch tool.
Mhm.
I think that oil prices, gasoline prices, a huge component in order for inflation to stay down, we need low oil prices.
Yeah.
And then I think I heard somebody say that going into the election that they'll start selling off the oil reserves in order to keep gasoline prices down for the election.
Yeah.
I don't think we have many oil reserves left.
Yeah, I think the SPR has been drained.
Depleted.
Yeah, but I mean, though, I think obviously anyone that, you know, the controlling party would want low gas prices, you know, going into an election. I would agree with that 100%. So, but yeah, I mean, you know, crude and oil drives the economy. So, I mean, higher, you know, lower prices help everything, you know, and make everything cheaper. So,
It'll be interesting to, you know, look at the tool that Robert just made us aware of and kind of overlay that over things like the XLE and, you know, see what kind of correlations we have.
yeah.
One of the things, Josh, just not a ton of numbers. We got some housing numbers tomorrow and Friday, quiet on Monday. Actually, some consumer confidence numbers on Friday too. Richmond manufacturing on Tuesday, and then, you know, PMI flash next Wednesday. As you and I were talking briefly this morning, you know, some of these numbers are just all over the board.
Yeah.
You know, the one today was just crazy. So, yeah, it's seems to be a market really driven by the whole rate thing.
This is Dave. I want to. Oh, sorry.
Go ahead, Dave.
Yeah, I was comment on that. Was an interesting, you know, CL discussion in crude oil there for a second there, and I would be willing to bet that's going to be the most volatile trade going into the election is the, you know, trade on oil and gas. I think that's going to be really exciting to watch that. And we just, I want to say 2 weeks ago, I saw news articles about starting to buy back some oil and refilling the strategic oil reserve. And when I
Right.
saw that, I thought, well, gee, it's January. They're going to fill it up now so that they can have some to sell off, just like you said. In July when June and July when the gas and oil usually raises gasoline prices for summer driving. And I was just wondering ahead of time whether they would like scale that back a little bit this year because it's an election year and they don't want to be seen as pirates as much as they usually do in the summer. So I think that'll be fun to watch the oil and gas trade we progress towards the election. And after the election, whoever wins, it's going to be a big swing, I think, in the oil and gas sector there. This CLE or XLE, I think, would be an interesting sector to watch or even trade that
Mhm.
in the summer months.
Yeah, XLE, quickly, I just looked up, the components, basically Exxon at 22%, Chevron at 17%, Conoco at 9%, and then a bunch of smaller components on a percentage basis.
Yeah, it might be interesting to, in the past, the Shook has chimed in a couple times on using the sector ETFs as a way to hedge against against a trade on a individual stock like Exxon or Chevron.
Yeah. Mhm.
Maybe we could coerce him into giving us his insights when we get towards let's say September or August, late August or September, maybe.
Well, we haven't given up on the idea of, having, Ashok as our guest from time to time. We haven't mentioned it only because it's been just challenging. He's got so much on his plate with the big company. So, hopefully sometime in the next couple of months, we'll get him on. Agreed, Josh?
Yeah. Yeah. Absolutely. Yeah, thanks, Dave. Anyone else? Before we wrap up, feel free. All right, well then we'll adjourn this meeting. Thank you all and do it again next week.
Thank you.
Have a good week.
Thanks for having me.